Hello, everyone, and welcome back. As always, we are grateful and blessed that you have joined us today. I'm Ben, the Tax Pro, and today we're talking about one of the biggest changes affecting retirees in the next 4 years, including 2025 tax year. Maybe you already filed the brand new $6,000 senior tax deduction. If you are 65 or older, this could save you hundreds, if not thousands of dollars. I've had so many clients that have benefited from this new legislation on your federal income taxes over 2025, 2026, 2027, and 2028. But here's the important part. Many people are confusing this with no tax on Social Security. That's not what Congress passed. Instead, Congress created a temporary additional federal tax deduction for qualifying seniors. Today, I'll explain who qualifies, how much you can deduct, when the deduction expires, income limits, and how to maximize all the deductions. And I'm going to walk you through a couple of real life examples so you can get more familiar with a practical example that applies to real life. Let's get started. What is the new senior deduction? Beginning with the 2025 tax year, qualifying taxpayers who are 65 or older can claim an additional $6,000 federal income tax deduction. That's $6,000 for one person and $2,000 for people who are married. If spouses are at least 65 and file jointly, the deduction can be $12,000 when it's maximized. The deduction is in addition to the regular standard deduction. And the exciting part is the existing additional deduction for taxpayers 65 or older doesn't cancel out the standard deduction. So these deductions stack on top of each other, giving you a standard deduction that could be $12,000 higher than prior years, especially if you file jointly. You don't have to itemize. So if you itemize or don't itemize, you still qualify. One of the best parts of this law is, like I just said, you can itemize or not itemize, so it doesn't stop you from getting the deduction if you itemize, all right? If you do file married filing separately, it can disqualify you for the deduction, so I want you to be careful with that if you're married and you file separately. So, who qualifies? Generally, you qualify if you're 65 years or older by December 31st of the tax year that you're in. So 2026, 2027, and 2028 are the years that are left. If you haven't filed 2025 and you were 65 by December 31st, 2025, you still qualify. If you're married, you generally must file a joint return to claim both deductions, like I said before. Congress also requires eligible taxpayers to have qualifying Social Security numbers. So unfortunately, people with I-10s won't qualify. Income limits and thresholds. Here's where tax planning can become very important. You receive the full deduction if your modified adjusted gross income is single, $75,000, or married filing jointly, up to $150,000. After that, the deduction begins to phase out slowly. So a general rule, a good rule of thumb, for every $1,000 your income exceeds the threshold, your deduction will be reduced by $60 until it goes down to zero. So it's effectively a 6% phase out for every $1,000 above the threshold. So let's use an example. Say Kate is 65, she's single, she files single, and she makes $175,000 a year. And then we have a married couple that makes $250,000 a year. Those are the maximum thresholds. So once you get to that point, if you're single and you make $175,000, or if you're married and you make $250,000, you will get none of the deduction. It only applies for tax years 2025, 2026, 2027, and 2028. Unless Congress extends it, the deduction expires after December 31st, 2028. So the full tax year of 2028 will still qualify for both taxpayers at joint, and obviously for you if you're a single filer. Let's give you another example. Example number 2. Susan is 68 years old. She's single. She has taxable retirement income of $70,000. Because she's under the qualifying limit, she qualifies for the entire $6,000 deduction. Instead of paying federal income tax on $70,000, she now pays tax on approximately $64,000 before considering her other deductions. If Susan's in the 22% federal tax bracket, that deduction alone can reduce her federal income tax by approximately $1,320, money that doesn't go to the government. She can leave in her retirement or spend whatever she needs to buy. simply because Congress created this new deduction. You should take advantage of it. Example number 2. Now let's look at John and Mary. They're both 70 years old. They're married. They do file a joint return. Their retirement income is $140,000 a year, and that includes Social Security. I meant that for the other example as well. Because they're below the income threshold, they receive the full $12,000 deduction. If they're in the 22% federal tax bracket, which they could be in a higher one, that deduction alone could reduce their federal tax liability by $2,640 and up to $5,000. That's real money that stays in their retirement or goes to disposable income for that couple. So, how to keep the deduction. Now let's talk about tax planning. Suppose your income is close to one of those phase-out limits or above. There may be legal strategies that help you preserve all or part of the deduction depending on your situation. So you want to stay in the sweet spot, which is under $75,000 for a single filer and under $150,000 for a joint. For example, carefully timing Roth IRA conversions is one way to do it. Another way is managing distributions from traditional retirement accounts. 3 would be deferring income into another tax year when appropriate. 4, using qualified charitable distributions when appropriate and if you're eligible. 5, coordinating capital gains and retirement withdrawals to make sure that you never go over these thresholds or you minimize the amount that you don't get. Every taxpayer's situation is different, but thoughtful planning may help you remain below the phase-out thresholds and preserve more of the temporary deduction. Important reminder, remember, this deduction reduces taxable income. It's not a tax credit. A deduction lowers the amount of money that you're taxed on. A tax credit reduces the tax that you have to pay. Confusing and an important distinction. Final thoughts. The new senior tax deduction is one of the most significant and helpful temporary tax benefits available to retirees. I can't tell you in my own practice how many clients have benefited from this. It's in the hundreds. If you're 65 or older, it could provide meaningful federal tax savings over the next 4 years. However, because income limits apply and every retirement situation is different, proper tax planning can make a substantial difference. If you'd like to see how this new tax deduction applies to your specific situation, schedule a consultation with me or another qualified tax professional here at NPS Tax Solutions. We would be happy and excited to help you review your retirement income, identify available deductions, and legally minimize your federal tax liability. Thank you again for joining us today. As always, we are grateful and blessed that you spent part of your day with us. I am Ben, the Tax Pro. If you found this video helpful, please like, subscribe, and share it with a friend or family member who may benefit from this important tax update. We'll see you in the next video. I would just like to say one more time that you are the folks who make all these episodes we make worth it, and I truly appreciate you. We'll see you in the next episode.